Now we will start with the divergence concept, and I would like to tell you that, okay, let us proceed, then I'll tell you as we proceed. So when we are talking about divergence, first let us understand the myth about divergence. So we all know, or everybody knows till now, that a bearish divergence is an indication that an uptrend is about to end, and a bullish divergence is an indication that a downtrend is about to end. So it is a myth. Now, like in the last session, we discussed how bearish divergence was occurring in a bull market and how a bullish divergence was occurring in a bear market. Now, what divergence are? Actually, divergence are detours of the ongoing trend. These do not always signal a trend change, right? So, when we see divergence, that are detours to the ongoing trend. That means the ongoing trend may rest for some time at the place it is, or it may stay sideways, or it may correct a little from the current levels. But it does not signal a trend change always. So when does it signal a trend change? We'll come to know as we proceed in the course. When RSI underperforms the price, it creates a bear divergence or bull divergence. That means the RSI is not in tandem with the price. RSI is underperforming the price. And when RSI underperforms the price, then we get divergence, whether bull or bear. Now, when the price makes a new low, that is a lower low, this is a lower low, and RSI is not making a new low, or it's making a new high. So this is price and this is RSI. Instead of making a new low, RSI does not make a new low. It makes a new high, or rather it remains where it is. So that shows a bull divergence, right? That means the price made a lower low. That means the price is still bearish, but the RSI retains itself from following the price, and it makes a higher high, a higher low, or it does not make a higher low, rather it makes a double bottom or stays where it is. Likewise, if the price action is making a new high, the RSI is not making a new high or making a lower high, then RSI is showing a bearish divergence. That means when the price is moving high or is making a new high, then the RSI does not make a new high. So price is making a new high, RSI is not making a new high. So this is a bearish divergence. Alright. So this is the example of bearish divergence. Price making a new high, RSI doesn't make a new high. It does not complement the price. And mark here what I have written: uptrend, bearish divergence. Uptrend. Alright. And similarly, bullish divergence, I have written downtrend bullish divergence. That means price is making a new low and RSI does not make a new low. That everybody of us know. Now there are certain types of divergence, that is class A divergence. What is class A divergence? Occurs when the price make a new high and the indicator make a lower high. Right? That is class A bearish divergence. That is when price make a new high, the indicator make a lower high. price is making a new high, indicator is making a lower high. What does it indicate? That it does not have sufficient momentum to surpass the price high. This becomes a very strong signal to shift in price momentum, right? So likewise we have done when we were trading oversold and overbought zones, that when the indicator turns up to and goes into the overbought zone, again come down and fails to go back to the overbought zone, that means the momentum here have decreased. There is a shift in price momentum, right? But I have not written that is a strong signal for sell or trend change. Just there is a shift in price momentum. So divergence are used for momentum trading. All right. Similarly, bullish divergence class A occurs when the price make a new low and the oscillator make a higher low. So price makes a new low and oscillator makes a higher low. All right, pretty simple. It indicates that the momentum has declined on the lower side, or the momentum has declined on the lower side and is not sufficient to surpass the previous low. So this is the momentum. It has been moving high and suddenly it moves up. That means the downside momentum has become weak and it has not been sufficiently strong to surpass this low again. So we can say the momentum on the downside have decreased. Momentum on the downside has decreased does not indicate that the momentum on the upside have increased. So this is a classic example of class A divergence. As you can see, in the bearish case, prices are making higher highs and indicator makes a lower high. In case of bullish divergence, prices make a lower low and indicators make a lower high. All right. So this is class A divergence. Now what is class B divergence? Occurs when the price make a double top and the oscillator makes a lower high. That means the price have made a double top and the oscillator has made a lower high. All right. So this double top could be defined as an area of equilibrium where the bulls and bears have equal power. Hence, caution is needed to trade this setup. So this double top does not mean that the bears have taken in charge of the trend. It just means that the power of bulls and bears here have been equalized. It does not mean that the price will melt. So we have to use caution to trade this setup. Similarly, what is bullish divergence class B? When prices make a double bottom and indicator make a higher low. So the prices are making W and the indicator is making a higher low. Right? So it is an area of equilibrium for the bears and the bulls. So this is the example of class B divergence. Double top in price and lower top on RSI. Similarly, double bottom in price and a higher bottom on the RSI. All right. This is class B divergence. What is class C divergence? When prices make a higher high and indicator stops at the same area of the previous rally. That means the indicator makes a double top, signifying the loss of the underlying momentum. Alright, so again the price is making a higher top, but the indicator this time stays on the same area. It makes a double top. That means again the momentum has lessened on the upside. Similarly, bullish divergence, when the prices make a lower low and indicator stops at the same position, or indicators make a double top bottom, right? It means the momentum is not very strong. So this is what the setups look like. Price is making a higher top, momentum making a double top, price making a lower low, momentum making a double bottom. This is class C divergence. This was important to explain because when we are going to trade divergence, this question comes up on the mind whether this is a divergence or not, right? So these are three types of divergence. We see. So let us see why divergence and how divergence occur and what are the implications. So this is the crude oil daily, and at point A you can see there is a divergence. At point B you can see there is a divergence, and at point C you can see there is a divergence. Now every time a divergence occurs, the price has made a new low. So in very simple words, wherever bullish divergence is occurring, price is making a new low. That means bullish divergence always occurs in a bear market. Similarly, this is the gold daily chart, and you can see divergence. At point B again we have a divergence. At point C again we have a divergence. So every time we see a bearish divergence in a bull market, or every time we see a bearish divergence, that means we may be in a bull market. It's not the end of the road. Alright. So bullish divergence comes in a bear market and bearish divergence comes in a bull market. So this is an example of trade. Now what happens? People see divergence, they get excited, they say that there is a divergence, this thing gonna change. Now they see that RSI has also cracked below 70, they are more happy, and then boom. So what you say? RSI is a stupid indicator. It doesn't work. The truth is this: people don't know how to use indicators. Not even RSI, but every damn indicator, people do not know how to use them. So points you have to remember: that bullish divergence come in bear market, bearish divergence comes in bull market. Divergence are detours to the primary trend. Now you have to do this after this session. When you open your charts and see, you have to identify a long-term bull market and you have to look for a bullish divergence. Similarly, you have to identify a long-term bear market and you have to look for bearish divergence, and you will find none. Go and try it yourself. Don't believe me, and you should not believe me until and unless you try it yourself. So this is divergence. Now this is my punch signal. how we trade divergence, and this is the fifth setup that we are doing here. Now believe me, this is the only way I have found out to trade divergence in my 15 years of trading. All other ways to trade divergence have incurred losses to me, and if you want to trade divergence in the right way, you should use only this way. All other ways are sham. So how we use this divergence? This is a trade setup. This is a swing trade. 2 to 5 bar setups. That means we need minimum of 2 bars and maximum of 5 bars. It is a 2 to 5 bar trade setup. Bullish, there is a question, it asks if bullish divergence occurs in, it is a downtrend. Of course, I have told you and I have given you that exercise. Please do it. You will understand it yourself, right? You have to work hard. Look at the charts and try to find it out yourself. Don't believe me. I continuously, repeatedly say one thing. Don't believe me. What I am coaching you here, or what I am teaching you here, please don't outright believe it until and unless you try it. It is my earnest request to you. Just assume that I am faking with you. I am telling you lies. You should not believe me. You should go and try this on the charts and see it yourself. It is my earnest request. If you really want to become a trader and earn from the market, this is you should do. We never trusted Andrew Cardwell. And he used to tell us that don't trust us. Go, whatever setups I am teaching you, try it on the real charts. Paper trade for at least 6 months. We do not become traders overnight. And I repeatedly say that doing a weekend course, doing a 3-day course, doing a 4-day course, you cannot become a trader. I have struggled more than 15 years till now to become a successful trader, and I still make the blunders that I shouldn't be making, right? So don't trust me, try it yourself. All right, so where we were? Yeah, this divergence setup is a 2 to 5 bar setup. We have to look for a minimum of 2 bar and maximum of 5 bars. We have to look for the bull divergence or bear divergence. We have to enter above the high in case of bull divergence and below the low in case of bear divergence of the previous bar. I'm just going through the rules. When I'll show you the charts, it will become clear. Targets are previous swing high or previous swing low. Stop loss is the low or high of the previous bar. This setup has a great risk reward setup. It gives good risk reward trade, and it is just a 3-star signal for me. We have signals from 3 stars to 10 stars. This has been rated according to the probabilities of the signals and the success ratio, and this is the 3-star signal. And when you will see the success ratio of this signal, you will just think what is all about 5 to 10 star signals. All right. So if you ever trade a divergence, this is only the way to trade a divergence. All other ways won't work. So now we are going to trade long bullish divergence. Now how it is done? First of all, we know that bullish divergence will occur in a downtrend. So at this bar, The closing price is 625.35 and the RSI is 29.42 at this bar. 1, 2, 3, 4. 4-bar signal. At the 4th bar, the close price is 622.85. So the close is lower. Here the close is 625.35. Here the close is 622.85. The RSI is 31.90. Here the RSI is 29.42. Here the RSI is 31.90. So RSI is higher than this bar. Close is lower than the previous close. So we have made a lower close and a higher RSI. So this is the bullish divergence in the definition of a bullish divergence. We will enter above the high of this candle on the next day. So entry is 638. Target is the swing high. Target is 668 and stop loss is 620, that is low of this candle. So a perfect trade setup, what is a perfect trade setup? You have an entry, you have an exit, you have a target. All the three ingredients of a trade setup is present. Entry, stop loss and target. So there is no subjectivity here when you trade divergence, because you have a defined entry, you have a defined exit and you have a defined target. So next candle confirms the long entry and targets are achieved, and my position is closed as soon as my target is achieved. This is a very important thing, you must keep it in your mind. As soon as our target is achieved, we have to close our position. We do not care whether after this the candle goes here, or whether price goes up here or it touches the sky. That is none of our business. When you are trading divergence, your entry, exit, stop loss is defined. Once you reach here, your target is achieved, get out of the stock. Am I clear on this? Next example. There are a lot of examples. It will make things very clear. So this is the weekly chart. Here the close is 554.89. RSI is 33.68. On the third candle, the close is 552.13. That means the close is lower. RSI is 35.50. That means the RSI is higher. Entry is 560. That is above this candle. Stop loss is 536 below this candle. Target is 636. That is this swing high. Risk to reward is 4. You risk 1 rupee to earn 4 rupee on this trade. Fabulous risk reward ratio. Entry has triggered. Bang on target. Get out of the stock. Alright. This is SPCL monthly chart. Close is 211.65 here. Here the close is 192.15. Here the RSI is 35.74. Here the RSI is 36.04. That means the RSI is higher and the close is lower. So we have a bullish divergence. Entry is above the high of this candle at 211. Stop loss is below the low of this candle, that is 158. Target is 381. The swing high, risk to reward is 3.2. This is the monthly chart. Entry triggers on the next candle, that is next month. And you bang on the targets. So from daily to weekly to monthly, the fractional nature of this trade setup, you can trade it. Very effective and very resultful trade setup. So this was the long setups. Now we discuss short setups. I'm discussing on a commodity. Excuse me, copper. Now the close is 416.45 on this candle, and see, I am only considering 2 to 5 candle setups, not more than that. This is more important. The close is 417.05 here. That is a higher close. The RSI is 73.60. Here the RSI is 69.99. That the RSI is lower. We have a bearish divergence. Entry is below the low of this candle. Stop is above the high of this 421. Target is 383. That means the swing high, the swing low. Trade triggered. You bang on the targets. There is no difference between the RSI. I am only talking about the bars. Risk is 7 rupees. Reward is 31. Risk reward ratio 4.42. Just consider the bars. Do not consider the RSI thing. I have not traded it on an hourly chart, and you should go and test it, because I do not trade chaos. This is what I have learned on the very first day of my life, not to trade chaos. I have explained it on the daily chart also, if you remember. This copper is on the daily chart only, copper daily. Don't try to fine tune this system anymore. Don't try to add anything more to this, because this system will get ruined. The biggest problem with novice traders or who are still learning trades is that they want to add anything and everything on a successful system to make it more successful, and they land making it a trash. So don't try to add anything more to this. Just follow and practice what is being coached. Too many cooks spoil a meal. Multi-collinearity. Please revise it again. So this is Nifty weekly. The close is 8835. Here the close is 8937.75. 1, 2, 3, 4, 5 bars. Risk is 69.27. Entry is at 8849. Stop loss is 9120. Target is 7961. And risk is reward is 3.27. Now, when Nifty is trading at 8937 levels, suddenly you are attending my seminar, and in that seminar I tell you that Nifty will retest Nifty can retest 7961, the first thing in your mind will be he has gone nuts. Entry triggered. You hit the bullseye. Now, this is a real-time trade setup that we identified, but as we were trading new at that time, we were learning trading. I was learning RSI basically at that time. I was doing my research with RSI at that time. So I didn't have the guts to trade this trade setup. This is Nifty monthly chart. The close here is 5907 and the close here is 6162. RSI is 85.02, RSI is 84.18. There is a bearish divergence in the Nifty monthly chart. Stop loss is 6201 and the target is 2575. 6201 to 2575. Risk reward 6, and I was predicting a 3000 point fall in Nifty. I spoke to my friends and told them that I am seeing this thing in Nifty. They told me not to publish this report because I will ruin my career. People will laugh at me. On the next month, the entry triggered and this happened. All right. Nothing more you need. This is enough to trade divergence. If by chance you add something more to it, I can challenge you, you will not able to take a single trade. Keep it simple. So, this was the divergence trade setup. So you go home after this session, sit with your charts and start finding this type of divergence. Then you will gain confidence in trading them. Now RSI and moving averages. So we use moving averages on RSI to determine trend. Moving average on RSI, not on price, but on RSI. We use 9 simple moving average as a short-term indicator and 45 exponential moving average as a long-term indicator. Now this 9 simple moving average is used on RSI and price as well, and this 45 exponential moving average is used on RSI and price as well. So how we determine trend using this 9 and 45 SMA EMA? First condition, when 9 moving average is greater than 45 moving average on RSI, and at the same time the 9 moving average is greater than 45 moving average on the price, the trend is considered to be up. When the 9 moving average is less than 45 moving average on the RSI, and when the 9 moving average is less than 45-day moving average on the price, the trend is considered as down. And when the 9 moving average is greater than 45 moving average on the RSI, but the 9 moving average is not greater than 45 moving average on the price, the trend is said to be sideways. Similarly, when the 9 moving average on the RSI is less than 45, but the 9 moving average on the price is greater than 45, the trend is considered to be sideways. Is it clear? Now, as we have moved from our first setup to this setup, we have accumulated slowly our trend determination price lists. Our trend determination lists we have accumulated very slowly, and we have been slowly making our trend determination list as we are moving forward in the course. We will accumulate it all at a single place to determine the trend, and we will get a exhaustive trend determination list. So this is 9, that is the red line is the 9 moving average and the black line is the 45-day moving average. Here it is positive on RSI, here it is positive on the price, we see a up movement. Here it is negative on the RSI and we see negative on the price, there is a down movement. Again both are positive and we yet see another up movement. Similarly, when the 9 is below the 45 on the RSI, but the 9 is above the 45 on the price, we get a sideways tangled price action. That is a sideways correction, a sideways accumulation. So here on the Reliance Infra, the price moving average is negative, the RSI moving average is negative, we get a downtrend. And here the RSI moving average become positive, the price moving average become positive, we get a up move. And at this place, the price moving average is above the positive and the RSI moving average is negative, we get a tangle sideways price movement. And here they both become negative and the price starts to move. We get an indication when to trade and when not to trade. All right. This was moving average on price, and it is an ingredient of our trend determination list, and we will use it further. We will see how this moving average is used in our trading. First of all, it gives us the trend idea whether we are in a uptrend, downtrend or sideways trend. That is, it tells us when we can trade and when we cannot trade. Secondly, how this trend determination, how this moving average can be used for trading. We will see the setups, how we can use this trading moving average as a for a trading purpose. Now we will discuss the sixth setup, that is the reversals. Now in the divergence, what was happening? RSI was underperforming the price. All right. But in the reversals, what happens? RSI overperforms the price. In a positive reversal, price make a higher low and RSI makes a lower low. In negative reversals, price make a lower high and RSI make a higher high. We will see on a chart. RSI positive reversals. RSI will move to a new swing low compared to the previous swing low. That means RSI has moved to a swing low. The price at the second swing means this is the second swing and this is the first swing. The price at the second swing of the RSI will not be less than the price at the previous swing. That means the price at the second swing should be more than the price at the first swing. For example, at this juncture, the price is 100 at the second swing, and at the first swing, the price should be 110. So, at the second swing, at the second, here the price should be 110, and here the price should be 100. So, at the second swing, the price is higher, and on the first swing, the price is lower. So, what will be the price chart look like? It will look like this. This is 110 and this is 100. So, when we compare it with the RSI chart, this swing is compared with this swing and this swing is compared with this swing. At the second swing of the RSI, the price is higher, and at the first swing, the price is lower. That means here the price should be higher than this point on the price, and this is the RSI chart. All right. This setup is positive reversal setup, which will lead to an up move. So, here you see the chart. This is the first swing, this is the second swing, this is the first swing, this is the second swing. Now, at this point, the price is higher, but RSI has made a lower low, and price has made a higher low. So, suppose at this point, the price will be higher when RSI is making a lower low. Am I making myself clear? This is quite important. So, negative reversal is just the opposite. The price at the second swing, RSI will move to a new swing high compared to the previous swing high. That means RSI has moved to a new swing high compared to the previous swing high. The price at the second swing of the RSI, this is the second swing of the RSI, is less than that of the first swing. So, here the price is 90 and here the price is 100. So, the second swing has a lower price. This is negative reversal pattern, and prices are probably to set to move down. Mark my word, whenever I am trading, I am thinking in probabilities. So, the price has made a lower high, but the RSI has made an higher high. This is negative reversal, or NR as I use it. Yes, it is an hidden divergence concept. You can call it a reverse divergence. You can call it a hidden divergence. But Andrew sir calls it a reversal because it reverses the trade. Right? Now on this chart you can see the levels marked from A to H, and every time when we have seen a positive reversal, the price have moved high. Just observe the chart for a minute or so. RSI makes a lower low, price makes a higher high. RSI makes a lower low, price makes a higher high. All right. UPL weekly. Let me complete this, then I will tell you what is the probability. Tech Mahindra monthly. Nickel daily. Now this is a negative reversal. That's on a downside. We see a higher high in RSI, a lower high in the price, higher high in RSI, lower high in the price. Everything has changed. BHEL weekly. Now you say divergence. Everyone is happy. On the weekly chart we see a divergence, but we are seeing a reversal here. Now you know that divergence come in a downtrend. There is a divergence, there is a reversal, there is a downtrend. What else you want? The chart is screaming at you, I'm not going to go up. Now the probability thing, that probability of this setup. I'm not going to tell you this. And rather I request you to find these on the charts and tell me. All right? This will help you. So where to take trade in a reversal? Now, this is the biggest challenge everybody faces. Now let me tell you one thing first, that reversals are indication of an uptrend to continue. Reversal in itself is not a trade setup. Reversal will tell you that the uptrend may continue up. But it won't tell you when to buy and where to buy. So here is the funda where you can buy a reversal, how you can trade a reversal. In case of a PR, buy when the price retraces back to a Fibo support or as a previous support. You can use Fibonacci, you can use swing high, swing low, you can use pivot points, the Woody pivot points, the traditional pivot points, the Camarilla pivot points, the D-mark pivot points, Lucas, Gann lines, anything that you use as support and resistance, trend line. But when you see a PR, wait for the prices to move to the previous support and then buy. Now confirm your buy with a candle or a bar pattern. Confirmation is the most important component when you are trading. If you're using candlesticks, buy on a potent candlestick pattern. And if you are using a bar chart, use the 3-bar, 4-bar chart pattern. Use the NR bars. Anything you want. But confirm at the support. And you can also execute at the change of pole points. That means where support becomes resistance. This is an example. You see a reversal. Now this is just an example. I'm not showing you on a support or something like that. There is a reversal. This is an layman way to trade a reversal. You see a positive reversal, price come down here. You see if it makes a positive reversal, it moves up, make a swing up, then down. Now you are getting one swing here. As soon as this swing is taken off, you buy it, and the previous swing is your target. This is the most simplified way to trade a reversal. In case of a negative reversal, sell when the price retraces back to a Fibonacci resistance or a previous resistance. Confirm your, this will be sell. Confirm your sell with a candle or a bar pattern. Sells can also be executed at change of pole points. So you see a negative reversal here. The prices move up, come down. So this is a change of pole pattern. This would have been a support here, a swing support. The prices moves up, come down, and now it is taking resistance at this support. Change of poles, and it moves down. This is the most simplified way to trade a reversal. This is a stop. But the ideal way is to, when you see a negative reversal, wait for the prices to move up to a previous resistance point. Any resistance point you use, maybe a Gann line, maybe a trend line, maybe your pivot points, maybe your Fibonacci ratios, maybe your Elliott waves, anything. Wait for the prices to revert back to the resistance point, and then wait for a confirmation signal with a candlestick or with an bar chart pattern, anything you use. And once the signal is confirmed, then you take the trade. Now, the price target thing. Price targets in a reversal or in a reversal funda is basically not for taking up profits. It tells us about the strength of the trend. And price, when you reach the price target of a reversal, it is basically to book your part profits here. Do not book your full profits. And it indicates a trend reversal. It indicates a trend continuation. So when you are seeing a positive reversal, you have calculated this price target. The price target is met. That means the trend is still strong on the upside. When the price target is met, you book your profit on the half of your lots and then keep some lots, because as the price target is met, the trend is strong. There may be some retracement and then the price may move up. Right? So how we calculate the price target? Now this is also very different. Anything you find on the net is incorrect. This is the right way only to calculate price targets. How? So first of all, this is a negative reversal. How you can make out? The price on the higher peak of the RSI is less than the price on the lower peak. The price on the higher peak is 121, the price on the lower peak is 123. So the price should be like this, like this. 123 and 121. Alright. Now first you take the X, that is this peak 123. Then you take the B point, this point, that is 121. Then you subtract these two, you get 2. Then you subtract this product, this result with the previous peak, with the previous bottom, that is 116. This is the price target of a negative reversal. All right. X minus B, X minus B is equal to 2. Now you deduct this 2 from this Y, you get 116. So the price target for this negative reversal is 116. Price target for positive reversals. So how you can make out this is a positive reversal? See the peak A on the RSI and see the trough A and trough B on the RSI, trough C on the RSI. It is 115 here, it is 118 here. So the prices should be like this, 115 here and 118 here. So we deduct A from C, you get a 3, and this is added to the previous peak. Of the RSI. Here we have to see what was the value of on the price on this peak. This is 120. You add this and it comes to 123. All right. Is the price targeting part okay? All right. Don't focus on the formula. This is just to make it simplify, because all the people are not so expert in mathematics. Right. I have trained person who are also studying in class 12, class 11, and even last batch I had a guy, the youngest student, who studies in class 8. Just imagine, at such a tender age of 14 years, he was trading the markets, and he sends me charts every day, and he practices around 200 charts every day, and he sends me. He sends his trades to me, paper trades to me, and that guy is awesome. And even the beauty of technical analysis is that anyone can use it. My daughter is 8 years old, and she likes to use candlesticks. Just for fun and as a time pass, I discuss candle patterns with her, and she identifies an hammer, she identifies bull engulfing, bear engulfing, everything else. She identifies the candle patterns, and she identifies support and resistance, and in a year or two I am very confident and she will start trading also on candlesticks at least. Technical analysis is very easy. People make it complicated. Now positive reversals, enhanced signal strength. Now we have used, previously we have learnt about the 9 and the 45 EMA settings and SMA settings. Now how we will use it? Now positive reversals that are occurring when the 9 is greater than 45 on RSI and the 9 is greater than on the price. Both are positive. More the strong the positive reversal is, and this positive reversal is called enhanced signal. Suppose the 9 SMA is greater than 45 EMA on the RSI and similarly the 9 SMA is greater than 45 EMA on the price also. Now that means we are in an uptrend and we get a positive reversal. So this positive reversal is an enhanced positive reversal and it has a more probability to succeed. Similarly, a negative positive reversal occurring when the trend is sideways. That means when the RSI on the price, when the moving average on the RSI and the moving average on the price are not in tandem with each other, that means the moving average on the price is negative and the moving average on the RSI is positive or vice versa, and in that case we get a positive reversal. Those reversal signals are called naked signals. That means though it is a positive reversal signal, it is not coming when the trend is said to be up. Have you got this? Enhanced and naked signals. Similarly, on the negative reversals, when both the moving averages are negative, we get a negative reversal. That is a more enhanced signal. Similarly, when both the moving average are not in tandem, that is either one is up and one is down, then these signals are called naked signals. All right. From the beginning till now, we have gathered bits and pieces of RSI fundas and RSI knowledge, and slowly or subconsciously we are building up a trend list, trend determination list, that if these things happen then we are in an uptrend, and if these things happen we are in a downtrend. In your subconscious mind a list has been building up that will tell you about the trend. Now when you will see the list in front of your eyes, you will understand it. Now, relationship between a divergence and a reversal. It is a very important thing that you must pay attention, and this is the real fun, and this is what many tutors, many so-called coaches will not teach you or will not even bother to tell you. There are two reasons: either they don't want to teach you, and second is they don't know by themselves, right? And the second reason is more probable. Divergence shows the possibility turning points at the end of the trends, right? But serial divergence are possible and may occur. Now we have seen that divergence show possibility of turning points at the end of the trends. When divergence occurs, it is not a sure shot signal that the prices will fall, or it is a change of trend. There are also chances of serial divergence also, right? That is like this. The prices are going up and up, and one divergence, two divergence, three divergences. Serial divergence is also, right? We know this. Reversals are the part of the ongoing trend. We know this also, right? We have learned. Now, listen to this very carefully. If a reversal occurs after a divergence, then the ongoing trend may not have ended. I read it again. When a reversal occurs after a divergence, then the ongoing trend may not have ended. Have you got this? Miss Goyal, can you tell me, have you got this thing? Thank you. When a divergence pattern is not followed by a reversal pattern, then the move may have ended and it may reverse. These are the two most important lines where maximum people fumble. We see many times the divergence works and many times the divergence does not work. This is the reason why it works and why it does not work. If you see, sir, I know it. Lalit sir, I know it. It's not a problem for me. I am always happy to help. If a reversal occurs after a divergence, the ongoing trend may not have ended. And when a divergence pattern is not followed by a reversal pattern, the move may have ended. These things are clear on your mind. Lately there was a setup. I also gave it in the pit. I don't remember which was it. There was a divergence followed by a reversal. I'm just missing out it. Just wanted to show you on the chart. divergence, and it was followed by a reversal. Divergence followed by a reversal. Positive reversal, bearish divergence. All right, many examples. All right. So, excuse me. So this is all it is all about. Now, a trend determination checklist that we were building up in our subconscious mind has come in front of us. Just excuse me for one moment. Okay. Or you have asked for a 5-minute break. Then we meet after 5 minutes. It's 1:34 right now. We'll meet at 1:39. Not much left. Okay, everyone back? All right. Just let me put up the PowerPoint again. Just one moment. Net is bugging me today. Okay, let us begin. Yeah. Now you can see my screen, right? Okay. So the trend determination checklist that we were building subconsciously when we were looking at our setups. Now for when we are in uptrend, the RSI range will be between 80 and 40. Our range rules concept. We will have bearish divergence in an uptrend. We will have positive reversals in an uptrend. The moving average on the price will be always positive, that is 9 will be above 45. Prices will make higher highs and higher lows, that is the basic definition of the uptrend, and positive reversal targets will be surpassed. So these are the ingredients of an uptrend. Similarly, downtrend range shifts from 60 to 20. 60 becomes the overbought levels and 20 become the oversold levels. We will see bullish divergence in downtrend. We will see negative reversals. The moving average on the price will be negative. That will be 9 will be below 45. Prices will be making lower highs and lower lows. That is the basic definition of the downtrend, and negative reversal targets will be met and surpassed. So these are the basic ingredients of a downtrending market. Alright, these are the ingredients of an uptrend or a downtrend. So when you see these things, you can easily say that you are in an uptrend or a downtrend. You can easily comment on the trend thing. They're quite simple things. What we have learned till now, everything comes as a snapshot in front of you when you do trend analysis. Biases in RSI analysis. First is confirmation bias. It is same thing as an multi-collinearity thing. When RSI tells you, when you see a positive reversal in RSI, suddenly what happens? You start feeling that the stock is positive, it's going to go up. You start searching the news for any good news in the stock market on the internet. And coincidentally, your focus will go only on the good news. Quarterly sales good, revenue good, management good, new product line, right? Suddenly you will start seeing only good things about this company. Why? Because there is a positive reversal in it. It's not like that. Alright? Positive reversals can fail also. So avoid this confirmation bias. Second is optimism bias. You have been using RSI for some time now, let's assume, and you see this range shift and you get overwhelmed, get over optimist. You think good about the company and start buying it. No, don't get optimist. Keep one thing in mind. When you will see the RSI, when you will start using RSI after this lessons, you will see the power of this tool, of course. But keep two things in mind. That RSI is the derivative of the price. Price is always the king. So RSI is derived from the price. Price is not derived from the RSI. So RSI does not runs the market. The market runs the RSI. RSI tells you which way the market may move. So if you see a positive reversal, don't get too much optimistic that it will shoot up. Wait for price to confirm your signal. Right? Now when you are driving on the road and there is a car in front of you and you need to move to the right, you need to take to the right turn, you need a right turn to you need to take a right turn, and in the car in front of you also needs to take a right turn. Now it gives you the right side indicator. That means the car will turn right. So you understand that the car will turn right. Unless and until the car tilts itself on the right side and takes the right lane, till then you are not confirmed unless the car does this. That means though it have signaled you that it will take a right turn, but it has not confirmed you yet. Suppose the car driver by chance or by mistake has put on this right indicator, and on the crossing it goes and stands straight, does not move and you are driving with your pace to take the right, and you take right, the driver stands there, you bang yourself to the car. So always wait for the confirmation. Don't trust the signals. Wait for the confirmation. So when you have the signal and you have the confirmation also, then you can overtake, or you can do anything. You know that you have to go right, no car is coming from this side, right? So you can easily overtake and go forward. But you have to wait for the confirmation. Loss aversion. What is loss aversion? Any idea? Now, loss aversion refers to your tendency when you prefer avoiding losses to acquire equivalent gains. That is, you think it's better not to lose 500 rupees to earn 500 rupees. Right. Now, you know that losses are more powerful and more psychological. When you are trading with RSI, you always tend to do this loss aversion bias. What will happen in the risk reward ratio? When you calculate this risk reward ratio, you will say, when you are suppose playing for an 1:1 trade ratio, right? Now you will avoid the loss. You will say it's better not to lose 5 to earn 5. Getting my point? So it is a type of endowment effect, because suppose you have bought Nifty. Suppose on Friday you have bought Nifty. Now what happens? Nifty went up and it has started coming down, right? Now what you will say and what you will think, you will put an endowment effect to the Nifty thing. That means you will say that I have bought Nifty, so it is very precious now and it won't fall, so I will not sell Nifty. So this is loss aversion. You are giving more endowment to the thing you are keeping, right? That means if you have an RSI signal, the prices went up, book your profits and get out. Right? You don't need, see, when you are buying something and you are getting 2 to 4 to 5% in a single day, even 2 to 3% in a single day, it's quite a formidable gain. You can take it and get out. You don't have to put an endowment effect to it. Since RSI has given a signal, that means this thing has become gold. It's not like that. Right? Now self-serving bias. That means it is an self-esteem attribute. That means what happens when you book profits in the markets? You will say that why I have booked profit? Because the RSI showed me a positive reversal. The prices went on support. I bought this thing Nifty and it moved 50 points. I booked profit. Next day the same signal occurs and it fails. What you will say? This is not because of the RSI, but something happened. Brexit happened. Finance minister came and said something. There was a surgical strike, and the Nifty fell down. And it was not the fault of RSI. No, accept the truth. The signals can fail. All right. This is self-serving bias. The planning fallacy. Now, what is this? Everything you keep planned beforehand. That this is a reversal. The reversal target is 300 on the upside. Now I will book profit when the reversal will meet its target 300. And now the price moves up. It touches 200. It touches 250. It touches 280. You are still on your planning thing that no, until and unless it touches 300, I won't get out. There is a resistance nearby. You don't see the resistance. You see your targets, and then boom, it comes down again. All right. So this is the planning fallacy. When you see a resistance, even when the RSI has given you a target of 300, but when the prices are moving up, it have reached 200, 250, and you see there is a resistance. As simple as that, take your profits and get out. All right. This is planning fallacy. Choice paralysis. 200 future contracts, 3,000 stocks, 1 RSI. You start with your charts, and on 200 charts, out of 200 charts, on 100 charts, you see positive reversals. You don't have the capacity, you don't have the finance to trade these 100 stocks. You got a choice paralysis. What to trade, what not to trade. And what happens actually? What you choose to trade, that doesn't move, and what you didn't choose to trade, that makes a new high. This is choice paralysis. Limit your world. For analysis, it is perfect, all right. For practice, you see 200 charts, 300 charts, 400 charts. For trading, please limit yourself to maximum 10 contracts, or on the higher side 15 contracts. Trade between 10 to 15 contracts only. Then only you will become a successful trader, or else forget it. All successful traders all over the world does not trade more than 5 contracts on a consistent basis. Both of you or all of you are in the pit, and when I share my positions, you will see Nifty and Bank Nifty dominating my positions maximum time. Very less stocks. Nifty and Bank Nifty movement have become subconscious in my mind right now. I don't even need the chart to see the previous prices. They are subconscious on my mind. The RSI levels are subconsciously installed. The Nifty levels are subconsciously installed. Where are the supports? Where are the resistance? where I have to book profits, where I have to enter. I don't need to see the chart, because from the last 4.5 years, I have been trading Nifty and Bank Nifty extensively. Hardly any 2 or 3 shares I will trade. If I get a very good setup, like in the last time, in the last session, or in the January month, in the pit, I have given one setup for ITC to trade long. I have given a setup of Arvind to go long in January, HDFC to go long, IndusInd to go long. Only these 2 or 3 setups I have traded, and except these 5 to 6 stocks, I have not traded any stock in the last 2.5 months. Only Nifty and Bank Nifty. For my clients also, I manage big portfolios. For my clients also, I do my maximum trading in Bank Nifty and Nifty, hardly 1 or 2 stocks. Alright? So the choice paralysis, be aware of it. Herding. The pit group, if you will see, it is a broadcast group. It is not an interactive group. There is a reason behind it. If I make it an interactive group, I am very sure there are very smart enough people, smarter than me, who will start posting their analysis on the group. No doubt they are very smarter than me. They are more trained and they are more experienced trader than me. They will start pressing and pulling their own analysis. There are some new traders, there are some new learners in the group who by default have traded the right thing or have chose the right thing, but looking at these people, they will say that his analysis look right, so I should dump my analysis and move with him. This is called herding. Where more people are moving, you should also move. Right? So suppose one group participant posts a chart and 2 or 3 participants liked it. Right? But your trading plan was not to trade it like that. But you will see that since 2-3 participants are liking it, or maybe 20-25 participants are liking it, you will start following them. So that's why I didn't make the group an interactive group. Right now I have 113 participants in the pit. And you can imagine the number of charts I get in a day, or the number of comments I get in a day. You will see my WhatsApp, you'll go mad. And how I control my emotions and how I control my feelings, it's just beyond explanation. Story versus analysis. Trust your analysis, not the story. Alright. So, a very recent example is ITC. Often we see that during the budget thing, there is a ban or there is a certain excise or certain extra tax on the tobacco thing, and what happens? ITC plummets. This time what happened? ITC was giving me a positive reversal. ITC was looking very good, and but what you will think, or what we will think, that today, since today is the budget day and everywhere there is a news that more extra tax will be implied on the tobacco thing, what you will do? You will not take the ITC trade. You will not take the ITC trade. All right. Now this is what happened. This was the budget day, 31st. This was the budget day, and this was the day before the budget. From 260 odd levels, it made a high of 295. And if you were with me in the pit at that time, this was my analysis at this level. You can see on the chart also. This is the level I am talking about. Sorry, this is the level I am talking about. And what I have written, if you can read it, that ITC has become a star candidate for long entries. As of now, lows of 250 will save RSI, and RSI is expected to do good in the near future. This was on the 1st of February, that is on the budget day. And what happened after it, it is in front of you. All right. So this is what story versus analysis is all about. Don't trust the story, just trust your analysis. Then there is a recency bias. This recency bias is when you remember the recent thing, that last time on HPCL positive reversal occurred, and there was a followed a move of around 200 points, or say 20-25 points. So you have this view on the back of your mind that last time there was a positive reversal in HPCL, and the following move gave 30 to 35 points in a single trade. Now this time there is again a positive reversal on HPCL, and you will assume again the same thing, that the following move should be of minimum 30 to 35 points. This may not happen. This positive reversal can fail also, or it may give you a bigger move than the last move. All right. So there is, forget what has happened in the recent. Forget what has happened in the past. Take every signal as a fresh and a new signal to trade. All right. Then the blind spot. Now, what is this? That you are believing that you are less biased than your peers, and that means when you have your RSI with you, you have done your analysis, and you have suddenly started believing that you are less biased than everybody else. But in the heart of heart, you know that you are more biased. You are putting more effect or more emphasis on a single signal because market have been moving in an uptrend and you see a positive reversal and you are more biased on it. Now if this positive reversal fails, then a simple funda is you should get out, because the trade signal that made you enter the trade is no more valid right now, but you are more biased because you think you are less biased. Am I clear? So these are the biases that I have faced personally during my span of trading with business, trading business. Though I have not very, I'm not very old in this field to talk about my experience, but still what I have felt till now, I have bought it in front of you. So this was it, our RSI course, and it is a mentor RSI course. I have discontinued this course right now because these are the things that we were using, and throughout this course I have used only two fundas that I have learned from Andrew sir, that is the reversals and the range rules. All other things has been learned myself by reading or by doing any other course with someone else or my experience. And I can assure you that after this course, if you practice it religiously, what you have learned, you will be a better trader than 99% traders on the floor. It all depends on your efforts. Minimum 200 to 300 charts per day, paper trading for 1.5 years, and then only you can become a trader. Doing a weekend course does not make you a trader. 10 to 12 years of intense study will make you a trader, a successful trader, nothing else. There is no shortcut in becoming a successful trader. Every time I meet people, every time I ask people why they want to learn trading, they will say that they want to earn, they want to switch their job, they want to earn by trading. But when I ask them how many hours or how many years you are ready to put into trading, they say that someone say 1 month, someone say even 2 hours a day, someone says कि एक सिस्टम मिल जाए तो बढ़िया है. It's better not to learn trading in that case. You always have good traders who give you service where you can earn money. People are spending more than 7 lakhs on mentorship programs to learn trading. And after spending these 7 lakhs with the big gurus and mentors, they come to traders, small traders like us, small coaches like us, and tell us that what I have taught in 10K, they haven't learned there in 7 lakhs. They tell us that our coaching price is underrated. And this is the same reason why I have discontinued this course. Because I haven't got a good trader or a good fellow whom I can teach this course. I used to teach this course before, but now it has been discontinued. A small feedback, if you can provide me about the course, how you have felt, on my email address, it will be great. It will help me in improving. These are my contact details. You can mail your feedback at getus@webmetric.com, or you can tweet your feedback at my handle or even on my Facebook page. So this is it, all about RSI. This session is been recorded and you will get the recording shortly. And you will have this recording for 3 months with you to trade, to revise. First of all, go and practice this on the paper. See these setups every day on the charts. And when you get confidence, then only go on the field to trade. This is only the way, and this is only what I can tell you. And we have this advanced session today also. Naresh ji and another guy is there with it. We'll start at 5. Till then, goodbye and happy trading. Thank you very much.